enjoy the discussion. So, okay, so we will start by presenting our panelists, and let's start with the lady, so Fleur, and then it will be Joss, Robert, and Petri.
Thank you, Fatima. Hello, everyone. My name is Fleur van Oppen. I'm fund manager at FMO, and I work in our blended finance department. I'll just leave it at that.
Thank you, Jess.
Yeah, hello, Jos Lemmens. I've had a long career in institutional investing, overseeing investments in forestry, agriculture, other food and natural capital related investments. But I've now struck out on my own, and I'm helping fund managers in these fields to understand how to speak to institutional investors, because I've seen it too often that both parties do not speak the same language. Can lead to lengthy processes, misunderstandings, and failures to reach an agreement. So, so that's what I do. I help them with governance, risk management, due diligence process, and with a special emphasis on sustainability, on stewardship, and biodiversity, which is the next new big thing, of course, and quite complicated.
Okay, thank you very much, Jess, and you will help us actually and our audience to shape their dialogue with investors and to better understand also the investors' needs. Roger?
Yes, hello everybody. I'm Roger Naylor. I have 17 years investing in global forestry. I previously worked for the UK's largest forestry fund manager, and then after that I worked for an international investment advisor, and my role there was really to go around the world looking for the best managers, the best funds for pension funds, predominantly Scandinavian, to invest with. And I was looking at the main forestry investment regions for institutional investors, which is the US, South America, and Oceania. And now I'm the portfolio manager for Evli's Impact Forest Fund, which is a forestry fund of funds. And we are investing in forestry strategies that have a carbon impact alongside a financial return. And Evli is an investment bank headquartered in Helsinki, Finland.
Thank you, Roger. And so Petri?
Hi, my name is Petri Kuusisto. I'm based in Finland. I've spent 30 years in various type of chief investment officer roles in Finland and Middle East. I've also had some side jobs. At 20 years ago, I was with launching Tornator, the 600,000 plus hectare forest land company. Then 10 years later, I was the co-founder for Dasos Capital, and after that, some smaller roles. Now, I'm unfortunately drifted into becoming a serial entrepreneur in the areas of impact investing and doing some research as a side hobby.
Okay, so thank you very much for this introduction. So you can see that we have an amazing panel with specialists in blended finance, with specialists in the investor needs, with specialists in forest investing, and with specialists in impact investing. So we will have a lot to share with you. So let's start with first actually defining the two key concepts: forestry and diversity. So I will start with you, just because you already mentioned the fact that diversity is a complex topic. Can you actually define it and tell us where you are seeing actually the key challenges?
Okay, so biodiversity, you know, I can tell you what it is not only, right? It is not only about endangered species like the spotted owl in California or the white rhino. You know, it's much more complex and pervasive. It is everywhere. It is in farmland, for instance, in the soil, right? It's about species, but lots of species, not only iconic and fluffy animals, but soil biota is a good example. But it is also about ecosystems, right? And about ecosystem services, the services we as humanity get from nature. It can be pollination, it can be watershed management, it can be whatever, clean air, up to ecotourism, for instance. But it is everywhere, and it is at the basis of everything. It is natural capital, is the basis of production capital, of human and social capital. And when you look at the UN SDGs, you see that the natural capital SDGs form the basis of this wedding cake, so to speak. So if I got one message, it is extremely important, and we can't do without. And managing it is quite complicated. You know, when you look at climate change, you know, we've got metric tons of carbon, but here in biodiversity, it's much more. There's so many aspects of it.
So biodiversity is a multidimensional topic, like actually the ESG topic. So Roger, to follow up on that, you have an amazing experience, a historical experience in investing in forestry. So can you first define what does it mean investing in forestry and what you have been seeing actually?
Yes, so the forestry asset class really emerged in the early 1980s. So it's had about a 40-year history. And over that 40 years, it's grown to about $100 billion in size. So it's a comparatively small asset class compared to things like infrastructure. But over that time, there has been specialist forestry fund managers, we call them TIMOs, Timberland Investment Management Organizations, and they've really been the vehicle through which institutional investors have invested through. So they typically raise commingled funds. I would say the low-hanging fruit of forestry investment are through the funds. They're typically $400 to $500 million in size. They acquire assets. The main investments have been in the US. That's probably about half of that $100 billion market. Also planting new forests down in South America. That's probably 20–25% of that market. And then also in Australia and New Zealand too. So I suppose institutional investors have the choice of owning forests directly, which means they need to take a little bit more of the due diligence responsibility and have more day-to-day say in the management of those forests. So that's a little bit more involved and needs a lot more capability in-house, which perhaps few of the investors have. So most, at least to start building their portfolios, have gone through the fund route. And that's what I would see as the low-hanging fruit for forestry investing. So typically they're large-scale funds, specialist forestry fund managers, multiple assets. They're harvesting, the revenues come from harvesting wood products. We're beginning to see carbon revenues come in. That's something new, and I'm sure we'll talk about that later in the panel. But also they're getting capital appreciation as well. So as the trees grow, they're growing in volume and value. So a lot of the returns are based on the biological growth and the capital appreciation of those forests. So that's kind of a rough characteristic or overview of the forestry investment asset class. And I would say the main reasons the institutions have gone into it are for diversification, low correlations to the other asset classes. That's had pretty good returns, around about 8% in the US over the last 30 years, has been a good inflation hedge in the past. And now we're beginning to see more the ESG benefits and sustainability benefits. So beginning to add forestry for its decarbonization benefits as well.
Okay, and I will come back to those points for our investors, but I would like you to react, Roger, on what just said about diversity. So can you actually give us a kind of perspective, forestry versus biodiversity? How are you seeing that in your investment decision?
Yeah, it's obviously crucial. I think forestry really benefits from a number of high-level frameworks, and the first of those would be forest certification. So these have been in existence for 25 years or more. They're independent audits that assets are being sustainably managed by accredited bodies under international agreements. And that really gives a certification that forests are being managed sustainably, and that includes the biodiversity angles as well. And then also, I would say, for most institutional investors, they're investing in commercial forests that are covered by a forest management plan. And a lot of that would include a biodiversity impact assessment and environmental social impact assessments. So they really are investing in an asset class that is certifiably sustainable and also that is well regulated. Most of the assets are located in regions with good regulations, where species are protected legally as well as just doing the right thing.
So you mentioned a lot of interesting things. We will continue to discuss on regulation, returns, actually risk diversification. I will come back on that. So Petri and asset class, which is quite interesting. So Petri, I would like you to react on that, as you have a very strong view on actually how those or this asset class can be tackled in the future.
Yes, it seems that the strategic asset allocation, which in the early days was equities, bonds, and cash, three blocks, was the starting point. But there isn't very common definition for what is an asset class. I think the most commonly used is from Mr. Greer from 1997, where he's just saying that an asset class is something where the assets bear fundamentally economic similarities to each other. And this is something most people are treating through the mathematics. But however, later Mr. Greer has been redefining or explaining further his meaning on the topics, and he's saying that it's not about correlation. It's about, you have to look at the underlying fundamental drivers of changes to the price of an asset, and just simplifying some practicalities here. I mean, forestry has gotten most of its value through the biological growth, and this biological growth is fundamentally very different driver to the price than what the corporate profitability would be on the equity markets. And similarly, you can look at the agriculture, where the crops are annual or biannual, and you can treat forestry as a long-term bond, because the biological growth is very predictable. And similarly, at one stage, I had to answer a question from a very difficult Scottish investor and explain the differences between forestry and agriculture. And at that point, I was explaining that the agriculture is more like owning a floating rate bond, because the crops vary and the price of the commodities vary more than the price of the timber.
But Petri, actually, you also mentioned the fact that we are moving to one single asset class, which is actually the natural capital solution, which would encompass everything. So can you tell us a little bit more about that vision you have, that new asset class that will emerge?
Yes, this original 3-block asset class definition has been split. If we look at the Yale, who maybe has 12 different asset classes, and people sometimes include hedge funds as an asset class, even though it's just a different investment strategy. Similarly, I very much like what Jos said earlier, that natural capital is the basis for all production capital. And if that is the case, And nowadays we can see some reports stating that the natural capital actually is building up 30, 40, depending who is writing the report of the global GDP. And if that is not a unique value driver, and if that doesn't create the right for being a separate asset class in the institutions' portfolios, then I think people are wrong. And this is my personal bet that we will have natural capital, similarly as some people have real estate as a separate asset class, and definitely also the dispersion also of the revenue streams in various natural capital asset classes will just grow the meaning of this asset class.
Okay, so we are starting the discussion by actually understanding that, like just tell us, biodiversity, it's a multidimensional topic with a lot of parameters. Through actually Roger, actually that we are investing in forestry also for actually looking for diversification, low coloration, and now carbon footprint. And we have Petri telling us, okay, but my vision is having actually a more holistic view of the situation and having a new asset class emerging, which is the natural capital solution. So Flor, I'm going now naturally to you, which is now, so the logic is actually that blended finance. So can you tell us, can you define what we can understand by blended finance, and how are you doing on daily basis to actually find solutions in terms of blended finance solutions?
Yes, thank you. Yeah, so very interesting. I think what Roger also said about the market is the forestry market is still small on a global scale, but it's growing. But it's mostly been focused on the Northern Hemisphere and Australia and New Zealand. As a DFI, we are focusing on emerging markets. And we've been investing in forestry in emerging markets for 10 to 15 years now. We see that is where the high growth rates are. So it would be interesting for institutional investors to go there. We also see that the largest forest stock is there, and the biggest deforestation rates are taking place there. So from our perspective, it's a very important area to look into. Now, we've been blended finance investor also for over 20 years. And blended finance actually means partnering or bridging public and private sector funding. And with blended finance programs, we work with a number of funders, and they are public funders. That started with the Dutch Ministry of Foreign Affairs, but we also work with the European Commission, and we work with the Green Climate Fund. And most recently, we've also started a partnership with the UK government, where they provide us with funding that we can invest in projects, in forestry projects in emerging markets, and take a first loss or de-risk the investment for further private sector funding. So it is really our goal to reach the commercial investors, and I think there's a big audience in this summit, and to make these assets in emerging markets investable for them. To do so, it's not easy. It really requires building partnerships and really learning to speak each other's language and understanding what each other's needs are.
Yeah, and I like actually what the way you phrase it, Flor. It's making the investment investable actually for the investors, and we are going to discuss that because investing in forestry and biodiversity is also investing in emerging markets, which is actually we need to educate actually the market about that. I just have a question from the public, and I think it's a very good one, so I would like to ask you that. What are the most common instruments in the market market to somehow protect the forestry investment, meaning in case of fire, storms, and so on. So who would like to pick up actually that question?
Yeah, maybe
Yes.
I can start, or yeah, okay. I'll hand over soon, Floor. But yeah, I mean, from what I've seen from the institutional side, and we are investing more in the US, and there have been forest fires in the US in the news over the last 12 months or so, and they typically occur on federally owned land, public lands, where there is less forest management. There's less boots on the ground to see them. So the tools sort of institutional ownership would have is that we have, first of all, geographic dispersal. So they're not contiguous assets. That's important, but also we can cut fire lanes into the forests to prevent the spread. They're much more highly managed, so we don't have the undergrowth to act as tinder to spread forest fires. And there are firefighting crews on hand in the forest to deal with fires quickly so they don't spread into large areas. So those are the main instruments, which is part of the silvicultural management. There is insurance available. I think typically most managers prefer to invest in fire prevention, but if they feel they have assets in high-risk areas, there is wind damage and fire insurance available to those managers too. So to give you some numbers, I mean, typically when we've done due diligence on managers and asked them to account for their losses on their portfolios, it's typically under 0.1% of an asset value annually. So it's actually very low loss rates within commercial forestry.
Okay, Flora, you wanted to say something about it?
Yeah, I totally agree. I think the key to investing in these assets is the management of your plantation or your area of land. And in emerging markets, this involves a whole landscaping approach where you involve the communities, where you take a very broad look at the stakeholders of a project. And in our experience, it takes a long time. So we do very thorough due diligence, and we work very closely with the asset managers before we invest to make sure that that the quality of the asset is guaranteed, or that they have the right capacity in-house to manage this correctly. So that takes a lot of time. It's a very complex job, but that is the key towards protecting your investment.
Yeah, so because it's a very technical topic, finally, it's not a generic topic. You need actually to make sure that you have the exact expertise when you are investing in. So a question to you, Joss, is we mentioned the fact that we need to, as Flora is doing, educate the market and the clients. We need to partnership to find solutions, but actually when you are an investor, what type of arbitrage are you ready to do to invest actually in having a positive impact in forestry and biodiversity versus actually what you are looking for, it's performance yield?
Okay. Let me start by adding to what the previous speaker said on what is important, right? And risk is important, right? And risk, we all know risk, we all know standard deviations and volatility, etc. But if you are investing in real assets, right, underground, trees in somewhere in an emerging market, these risks are hardly diversifiable, right? Do you have title to the land, for instance? Can you buy the land? Maybe you don't buy the land, but are the trees yours, right? Is there infrastructure, right? You can have trees, but if there's no mill, supposing you want to, harvest the tree, if there's no mill in the neighborhood, or if there's only one mill in the neighborhood, you might get in trouble, right? So before you look at, is this the right manager? You need to look at what are the risks and am I willing to take those risks? And sometimes you can say, well, I'm not totally willing to take those risks. And maybe you have to look at blended finance, at somebody else taking first loss or whatever. But I think that blended finance for that purpose, it can be a very good tool. And onto your question of, what would an institutional investor be willing to have a lower return if he or she would be investing in something with a very beneficial long-term effect on whatever, on biodiversity, on climate, etc. And my answer to that would be, it depends on the risk, right? I mean, if I would invest in this particular country, in a particular type of asset class, I would need to tell my investment committee what is the required return. I would have to calculate that. There's quite a bit of modeling around that. So I would need so for instance, you invest in the US, right? What is it, 5% real these days, what you can expect on return. So if I would invest in a more exciting country, right, then I would need extra return given the extra risk. So I wouldn't necessarily accept a lower risk, return if the risk is higher, and if I cannot measure the added benefits of it, right? I need to see, okay, but I, as the investor, will get the extra benefits, and these extra benefits are X, Y, Z. If I see that, if these benefits come in 50 years, then in a discounted cash method, it's not visible.
It's a risk long term and ability to measure actually that benefit versus the fact that you may have to accept a lower return. I'm having a lot of interesting questions actually from the audience that can keep the discussion and shape the discussion in another way, which is really interesting. So I will for you and let me know who will be delighted to take that next question. Does space technology actually apply to agriculture, play a role in your decision of choosing in which system start to invest and in which system not? So I mean, they mean by space technology the ability to map the geolocalization. So Flora explained that she was looking for a specific actually knowledge, because investing in industry, agriculture, biodiversity require actually a specific knowledge. Here we are also talking about technology, which is super interesting, also mapping actually what is happening on Earth. So who would like to take the question?
I can do that.
Just tell us.
Yeah. So you were talking about, for instance, remote sensing technologies, right? And I think these technologies are quite important for your risk management, right? Your forest or your land is somewhere far away, right? It's not in Holland where I'm at. It's somewhere far away, and you don't have boots on the ground usually. So measuring your risk again, and risk can be biodiversity risk, climate risk, deforestation risk, reputational risks. All these risks can be measured in some way or other via remote sensing, and we need to get there, so that would increase again the liquidity of such investments. The risks will be lowered because you can measure what's actually happening, and it can then also create new benefits as a biodiversity offsets, etc. If you can measure it, you know, and canopy and such, and carbon and forest is relatively easy to measure, but start measuring biodiversity, you know, it's I'm hopeful, but we're not there yet.
Okay. Okay. So so what we are actually realizing is technology is actually a new parameter we like to take into account on the top of a partnership actually to develop that. I can see, Flor, that you have the Sustainable Development Goals, the 8th, the 10th, and the 13th. You may want to add the last one, the 17, the partnership, which is exactly what you are doing. I have another question from the audience, and more around actually the institutional investors' view, and it's about the retention risk. Roger, you just explained us that actually it's a small asset class, even if it's a growing. So it's not that it's a small funds, and you have investors and. We can sovereign fund investors, biggest investors who would like actually to invest, but it's too small for them. They can actually put, and they have to put a higher tickets on it. So how are you actually having that discussion when you have that discussion, and how are you seeing actually the market tackling that point in the future, because it's a growing asset class. So you will face that situation more and more.
Yeah, I think the new, if you like, the new entrants to the asset class, or where it's going to expand to, the new entrants are really the corporate investors, and they are certainly looking for the carbon benefits from forestry. So they're looking to decarbonize their value chains. There's various reasons. I mean, one is sort of value-based leadership to improve their reputation amongst customers. Also to secure their supply chains if they're commodity dealers or furniture manufacturers, but also to do the right thing. And they've mentioned these net zero targets, and I think I read a figure recently that, you know, there's 67 trillion of net zero targets announced from the corporates. And if we've mentioned natural climate solutions, they can be around about 37% of the solution to climate change. And within that, forestry is the majority, maybe 60 or perhaps even up to 3/4. So that means there's going to be a lot of capital interested in forestry and potentially flowing into forestry. And the existing markets, I mean, the transaction market in the US is 2 to 3 billion a year. Over the last 10 years, it peaked in 2006 at about 6 billion. So a lot of that capital is going to have to be placed in new regions, and in regions where at least institutional investors haven't been active, and that's Africa and Asia. Yeah. So I think for natural climate solutions, the new opportunity is in emerging markets. And that will require, I mean, for institutional funds, you know, I can think of one fund manager active in Africa, another fund manager who has some assets in South Africa. There's one fund manager active in Asia. And we've just had an announcement from quite a large forestry fund manager who are going to raise a $500 million fund in Africa, partnering with the DFIs. So I think if the more established forestry, that the TMOs are going to go into these markets, then they have to build up capabilities around the social and environmental aspects. So I think I could see them partnering with environmental NGOs who can bring knowledge of the climate science, but also the experience of dealing with local communities. So I think that's where the asset class is moving to, partnerships between the fund managers, environmental groups, to expand into new regions in emerging markets. And you know, institutions haven't invested there because the end markets for the wood are not well developed. We can grow the trees, but the formal markets for construction, timber, pulp, whatever, are not present. So there's a high degree of market risk. The investment case is not clear. And I think this is where Flor and the blended finance comes in to link institutional investors who have low risk appetite, with the DFIs, the philanthropic organizations who can take higher risks, and blended finance can bridge the two of them to expand the asset.
Yeah, and if I can add, exactly, and in our blended finance programs, we also have started including a tranche or a facility that's available to these forestry managers to learn, to set a first step in new geographies, to start developing new projects for the first time, because they may also be reluctant because it's unknown, so the risk is still very high. So that exactly is one of the first steps that DFIs, and specifically with blended finance solutions, can help accelerate.
Absolutely. And Petri, I would like to have your view how an investor like the Finland pension plan or the sovereign fund are looking in this type of investment.
Well, I think Nordic investors have been active investors in timberland, forest land for quite some time, and have invested also to southern hemisphere plantations where the forest industry has been drifting because of lower costs. And what Roger mentioned about the new entrants, about the corporates, is going to be big, but they are not going to compete on the same lands, because as Roger said, the corporates and some of them are setting up their own funds, but they are mostly interested into the carbon credits so that they can clean their own conscience and go forward. I think the interesting part is that where do we find money which is going to reforest some of the tropical lands, and there are also some funds who are doing that, but the scale is quite small. I mean, there's somebody in Panama, some people are doing that in Brazil, but we need a lot of scale to try to get the tropical forest lands back.
Okay.
And for that there can be, we mostly understand forestry and agriculture investments into investing into land, typically often in through a private equity structure or doing direct investments, but there are debt investments also available for institutions, and this can be a much more appealing way to some larger investors, because they don't have the technical knowledge nor have the knowledge for tackling down the social risk what the communities may represent. So it's very much a new kind of a way to collaborate, where Western institutional money would need to find trusted local entities with whom to cooperate.
Yeah. So again, a collaboration at all levels in this type of investment. And I like the last point you mentioned, Petri. It's not only in equity; it's also in debt. Actually, we can have both. I'm having a lot of questions from the audience, and I have one. So we have a lot of interest for this topic. So the next one is for you. It's directed to you, Roger. So, is the inflow of climate capital that you just mentioned an opportunity or risk? And on the bracket, driving prices up, returns down.
I think when it comes to carbon, what I see, particularly in the US carbon markets, is that it's potentially an additional source of return. So if you take the US case, acquiring existing forests, and you don't necessarily have to register all of that forest in a carbon market. You can choose certain stands that have maybe lower value species or more difficult to harvest or access sites, and you can put those into a carbon project. So, for example, the California offset market. And in that way, it kind of increases the optionality and increases or adds another source of revenue. So you can manage that property and put your high value timber stands into traditional markets, harvesting them for logs, and also some stands where you think you can get a higher price from carbon. You can register those in offset projects, and selling the carbon credits can also bring forward the cash flows as well. So I think when it comes to carbon, it can actually be a source of higher investment returns than a traditional forestry model. I think I also saw a question about how do you monetize biodiversity, and I think that's a lot more difficult. And certainly for impact, when it comes to carbon, I don't really see a trade-off between impact and return. Both are relying on the biological growth of the trees. You know, the faster they grow, the more carbon impact you get, and also potentially higher return. So if you're investing for carbon and forestry, you don't really have a trade-off. If you then start to bring in biodiversity, then I think you do, because at the moment there aren't really markets for biodiversity. I mean, the ways to monetize it, I think, would be willingness to pay, but there's not really a large-scale market for that. So then you start to bring in the question, how much are investors willing to trade off that return for impact? And I don't really have the answer for that. I think that will play out over the next few years. I think one of the things that will drive it is that, at least at Evli, we see that there's going to be greater policies and regulations coming in to report your carbon footprint. And so investors will be looking for assets that will lower the carbon footprint of their portfolios. And if they see value in doing that, then they may be willing to trade off some of their investment return for the value of lowering their carbon footprints, and maybe not getting sort of fines or whatever might come along, extra taxes if the carbon taxes come in. And so, you know, there may be a trade-off there.
Absolutely, and the focus of institutional investors are, for the moment, or at least the one who join the race to net zero, is to decarbonize their portfolio at all means. So that will be a focus, and forestry, biodiversity, if you manage to define it, can be actually a solution. Just, you wanted to add something?
Yes, I want to say something about, you know, we've been discussing mostly forestry, like logging and carbon, but there are other investment opportunities, and granted, it is not yet a very liquid market, you know, but the possibility is there. For instance, for green infrastructure, right? I mean, forestry, its own asset class, yeah, maybe, but it looks and walks and talks like infrastructure, right? You have to do the same due diligence, the same things, you know, it could be together. Also, the returns are infrastructure-like. But for instance, you know, payment for ecosystem services, that is probably a growth market, because, for instance, you can, a government or local government or whatever can pay an investor to keep, for instance, a forest alive, standing, whether or not so to make sure to have a high quality watershed. Or the example everybody always uses is a mangrove forest, right? To ensure against flood risk. You know, somebody has to keep it alive, and the community behind the mangrove forest could pay you for that service. So there are possibilities, but there's a lot of talk, but not yet much action. But I'm hopeful it will start. soon.
But yeah, and just you mentioned a very good point, because finally everything is interlinked. We are talking about forestry, biodiversity, but you mentioned actually green infrastructure. You can also have an impact in terms of forestry and biodiversity, maybe also through actually infrastructure investment, which could be quite key. I would like actually to have your view, Flora, on that a carbon focus. As a blended finance specialist, you are building partnership between private and public. Are you seeing the discussion you are having and the project, the blender actually finance solutions you are building actually for the different projects? Are you seeing them impacted by this race to net zero? And do you expect that to be impacted by that need to decarbonize the portfolios?
Yes, I'm glad you asked. Yes, absolutely. So we've been seeing, and especially in this last year, all of our clients are being approached by corporates who need to buy carbon credits. And they're all looking for a source to get these carbon credits, especially high quality carbon credits. So when there is additional, I saw one of the questions also, when there are additional benefits for communities or biodiversity. And we are also, yeah, it's really developing quite rapidly. We're also starting to try to get our heads around what our role can be there. What we do see is also from a DFI point of view, to get involved in its segment, it is a blended finance game, which means we are also influenced or governed, maybe that's a better word, by the policies of our funders, which are the UK government, the Dutch government, the Green Climate Fund, etc. So, for example, when we look at investors who invest in a project specifically for carbon credits, then we also take we also scrutinize the role of that investor. So, are they taking the same? Well, are they getting access to these carbon credits at a fair market value, for example? If carbon prices skyrocket, is there a mechanism in place that a part of the returns flows back to the communities or to the local jurisdictional level? Because that is going to be a very important barrier to guarding the quality of those credits. So we really look at, we're really, again, trying to get our heads around how best to govern that. It's quite interesting.
So, and I will make actually the link with the following questions. You mentioned actually the quality carbon credit. It just actually having a quantity of carbon credit in order to tick the boxes and decarbonize your portfolio is looking for the quality one. And what do you mean? I assume for a quality one is having a real positive impact, not just ticking the box. So just we can be optimistic, as you said, if Flora is telling us that they are seeing actually investors looking for quality carbon credit. And we have a question which is linked to that is, do we see a value, a premium now, or do we expect in the future a premium for an investment which is gathering actually positive impact in terms of carbon, social, so E, carbon, S, social, and G, gender diversity, for instance? Are you seeing actually the market rewarding this type of investment?
Yeah, at the moment we are really seeing this price developing, going up. Not everyone has the same opinion. It's still very difficult to forecast what prices will be doing. We're hopeful that that there will be that premium and that the price does continue moving up, because then if you do find a model where the benefits are shared with the local communities or geographies, at least, where these carbon credits come from, then we are really adding value to guarding these assets and to keeping nature safe.
You are real actually a blended finance specialist because we were starting talking about, do we have a financial benefit, a premium in the price I will have to pay or in the money I will have to lend, and you just link that to say, okay, but we need to have an alignment of interest to make sure that the benefits will also actually share with the local communities. It's just not a question of having a finance benefits, but also sharing it with the people on the ground. So Roger, you have been investing in forestry since a while, managing portfolios like that since a while. Are you seeing actually the price changing? Are you seeing that premium emerging? What type of discussion are you having in the pricing?
Yeah, I think carbon credit pricing are still very low, particularly in the voluntary markets. I mean, they're $3-4 per ton, which is not really high enough to affect change. You're not going to start managing forests differently or be able to include sort of costly impact or protection studies at that sort of carbon price. I think in the compliance market, California I mentioned, the New Zealand emission trading scheme, prices are around about $25-35 a ton, which is better, but we probably still need them another $15-20 to really start to change how forestry is being managed. Bank of England, I think it was last year or early this year, said prepare for carbon prices to reach $100 a ton by 2030. So I think it's moving upwards. That seems to be the direction where the market is going, but it's still pretty low prices at the moment.
Okay, so still not in that.
Yeah, I think when you come to quality of credits, we're beginning to see sort of carbon plus credits. So it's a carbon credit with a biodiversity layer added on top. So that goes to Floor's comments about the quality of the credit. So we are starting to see that it's not just about carbon, but people are looking for credits with carbon and an extra ecosystem layer added on top of that.
Okay, so I would like also, thank you, Roger. Yeah, I saw you just. I would like also to move to another topic, which is a key one, but also summarizing what we have discussed previously. It's the regulation. And the regulation is one of the key drivers. So, and that that race to net zero is also actually a kind of regulation pushing to actually decarbonize the portfolio, and specifically in Europe, with what we have been seeing with the SFDR, the taxonomy, and the new regulation coming in 2022. So how are you seeing the regulation applying to your specific asset class? And how are you expecting your day-to-day job to change and your discussion with the investors to change? So just you can elaborate on the previous question, but if you can also actually follow up on this one.
Yeah. Just briefly, what I want to say in carbon credits is that we need more liquidity, right? The carbon credits should be fungible, right? They should all be the same, and not one of high quality, the other of low quality. It's just like the start of the OTC, or over-the-counter market in options and futures. Everything was different, and that's very complicated for an investor. They need all to be the same, and maybe then they're a bit simpler, but they will have much more appeal for an investor, also in terms of liquidity. So that's that. Regulation, it's happening all around us, right? The EU taxonomy, SFDR in the UK, they are working on something slightly different again, and perhaps the US will follow. But it is quite important. You will have to comply with the SFDR. you probably want not want all your investments to be gray investments, right? You want them to at least be light green or dark green. And I was just again going through the EU taxonomy, right, on the draft for the other objectives. Now we
just sorry to interrupt you. We have only 3 minutes, so if you can.
Fine.
I would like to give.
It is extremely complicated. It's extremely complicated, but you will have to apply.
Okay.
That's my point.
Sorry. I like it. Super efficient. It's complicated, so we have just few minutes left. I will give you back the final word. Just you deserve it. So, Flor, Roger, Petri, we have 3 minutes. Your key takeaways, and just you will conclude everything. So, Flor.
Yeah, and I think I would just say to the audience that please consider this blended finance option and look us up if you're interested in going into these emerging markets. There are some fund managers that we plan to invest in that have very scalable ambitions, looking to set up big platforms. So there may be opportunities for you.
Thank you. Roger.
Yeah, I think we've talked a lot about carbon. I think there's also the impact from the traditional sort of forestry model of harvesting and supply of wood products for construction, displacing steel and concrete, replacing plastics in packaging and so on. I think I would move away also from labeling funds as either ESG funds or impact funds. And I think institutional investors are backing investments that contribute to a sustainable future. And I think forestry is one of those that really has some of the answer to this. And it is transitioning to a forest climate solutions asset class as well.
Thank you, Roger. Petri?
Yeah, I think there's one thing which to me sounds always funny, that we talk about financing needs for climate change, for whatever kind of natural capital solution, and we like to show figures in trillions and trillions to keep our pessimistic and cynical mode on. But then when we turn the aspect to institutional investors, and then they are telling, oh, like Roger was saying, that this is such a small asset class, and somehow this is a dilemma. It's a funny funding gap. You know, somebody is saying there's not enough deal flow, and the other side is crying for money. And clearly blended finance, which is a name I don't like at all, could be a solution. Could be a solution. It's I rather like more the integrated capital. But I think one of the problems, we are writing a research report on
Petri, last word. We have few seconds, and we have just.
Yeah. So we are writing a report on blended finance where people don't know each other.
Okay, and just really few seconds.
Yes, basically, if we don't want to call it impact or ESG, we have to call it Article 8 or Article 9. You know, regulation is here. It was complicated, it's getting more complicated, and you will have to comply. And I can help with that.
Perfect. Thank you very much. Thank you for this dynamic discussion. I hope that the audience like it. At least it was a pleasure to be with you. And Warren, I think the mic is yours.